The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The market rallies, but it's not tech stocks leading the charge. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Katie Greifeld. We're kicking off the closing bell here in the U.S. Let's take a look at where we stand. The S&P 500 higher by about 0.6%, a little bit better when you take a look at the NASDAQ 100. I did want to highlight what is going on with crude. We were talking about crude yesterday, of course, in the context of what we saw unfold over the weekend in Venezuela. We saw a rally yesterday in crude, a little bit unintuitive today. You can see that's unwinding a bit here. Crude oil down about 2.4%. And then you take a look at gold getting a little bit of a haven bid here. Gold rising slightly higher by about 0.7%, Romaine.
Yeah, but you go back up to the top of the screen there with the S&P trying to test that 7,000 level, a three-day rally that looks impressive on the surface with sizable gains from Amazon, Western Digital, and Palantir. But pay attention to the laggards because there's a more compelling story there. Apple sliding for a fifth straight day, Cisco for a sixth, Tesla down for the eighth time in the past 10 sessions, and chipmaker AMD taking a hit as investors express skepticism about CEO Lisa Su's assertion that AI demand is still soaring.
You know, we think we have to increase compute by another 100 times as you go over the next, 4 or 5 years. And I introduced a term last night, the yottaflop. People are like, what is a yottaflop? A yottaflop is actually 10 to the 24th in terms of flops. So that's a 1 followed by 24 zeros.
Yotta flops, set of flops, Fosbury flops, put that all aside. She did actually quantify demand by actually noting that growth from 1 billion active AI users today to an estimated 5 billion 5 years from now, that can only be achieved with a massive uptick in compute capacity, which would presumably keep corporate AI spending on tilt. But equity investors, not so sure, continuing to diversify with the small cap Russell 2000 outperforming for a third straight day to start the year of 2026. Now, while the tech rally is looking a bit more disjointed given concerns about an AI bubble, the inflation in metals prices, that continues unconstrained. Silver up a third straight day to a record high. Aluminum on a 5-day run. Copper prices up for the 11th time in the past 12 sessions. And how about nickel? The dormant trade, dormant no more. Today, spiking as much as 10%, Katie, the most in more than 2 years.
Fascinating what's going on with metals, but I want to go back to what Romaine was saying about AI. We know that NVIDIA has done a lot of heavy lifting for this market in particular, but take a look at the chart behind me. In blue, you have the S&P 500. In white, you have NVIDIA. NVIDIA, the share price, it actually peaked in November, but if you take a look at what is unfolding here just over the past couple months, the S&P 500, it's managed to hit 3 straight record highs in that time. And you can see that NVIDIA still, it is really explains sort of the story of the big benchmark over the past couple of years. But maybe, Romaine, as we talk about rotation, as we talk about the rally broadening out, this chart could suggest that that's starting to begin.
Of course, and that is all the focus right now. And as we kick off the show, some breaking news in the AI space. This on Elon Musk's AI venture, XAI. We're now learning here that the company has raised $20 billion in a Series E round, and that exceeds its target by about $5 billion. It was seeking to raise about $15 billion. Looks like it got $20 billion based on Bloomberg reporting. XAI is saying that strategic investors in that round included, who else, Katie Greifeld? NVIDIA. Julie Biel joins us right now, Chief Market Strategist, Portfolio Manager, and Senior Research Analyst at Kayne Anderson Rudnick. And Julie, I had another question to start off with, but I do want to ask you here about the AI spend. And, while there's certainly a lot of skepticism, a lot of doubt as to how far we've gone, when you start to see valuations for an XAI like this, some of the other valuations we saw at the end of the year for OpenAI and Anthropic and others here, it doesn't seem to suggest that investors are really backing away from this trade just yet.
I think not at all. I think there is just so much FOMO that's present in public markets and private markets. People feel like they have to have access to these companies. They really feel like they're going to be the drivers of growth and the disruption. And I think the disruption is here. What's unclear to me are what are the economics of these businesses and why are the disruptors going to be the winners? Airlines were very disruptive, but it took them a long time to make any money.
Well, and that gets to the idea, too, here. I mean, look, I don't think anyone doubts the long-term promise of all of this. But in the short term, one of the most read stories on the Bloomberg terminal right now is about data center cooling stocks, the idea that Jensen Huang's commentary about maybe a potential slowdown in the pace of this build-out. And it's not so much Julie, whether it's a good investment, but whether maybe investors got a little bit too ahead of themselves in ascribing the valuations, at least in the public markets that we saw.
I think that's right. And I think it makes sense to me when we're talking about Google and Meta in terms of their businesses and how AI is going to improve them. I feel really confident that the writing is clear for that. But if I'm talking about more of these adjacent companies, the picks and shovels, people are making a lot of assumptions that they know exactly what the velocity and the growth is going to be and the earnings impact. And I just don't think it's super clear. We have such diverging points of view in terms of how much compute this is going to need, how much cooling, all of that. It's really kind of up for debate. So trying to play these adjacent plays in companies that are not necessarily super high quality the way that a Google is, to me is a risky approach.
It's hard, though, Julie, right? Because you think about Google, for example, you think about some of the other names that populate the Magnificent Seven, and you could look at that from the perspective of an investor and say, that already has so much good news priced in. That story is already priced in. Maybe it would make more sense to try to find where the puck is going to go next. But, I mean, to your point, especially when it comes to data center cooling stocks today, that comes with a lot of risk.
Yeah, I think you're better off, instead of trying to be able to predict exactly where the puck is going, you're better off trying to focus on the actual fundamentals in the here and now. And so some of these cooling data center companies, they actually have other good adjacent businesses, and that's where I would focus and think of the AI as a sweetener. But trying to find something that is completely dependent on every single thing in AI working out just the way we think, it's not how I would approach it, because I just think that this is such an open-ended technology, and our ability to predict how well a technology is going to work and how it's going to impact things like employment is terrible. When ATMs came out, we assumed there would be no more bank managers, and now we have the same amount as we did when we released ATMs because it freed them up to do other things. That's really simple technology. AI is so much more complicated, so I think the ability to kind of predict exactly how it's going to turn out is really hard.
Yeah, certainly, and it's an interesting bit of context to think about it through the lens of ATMs. Beyond, though, what we're seeing with the tech trade, with AI, I want to go back to the stat that Romaine brought up at the top of the show, that you think about the small caps as measured by the Russell 2000. So far this year, they've been outperforming, and you think about this broadening trade that a lot of folks have been calling for. I wonder, whether you see that being sustainable as we get through deeper into 2026.
I do think there is sustainability, assuming that we get the earnings growth that people are expecting. And that's what's really been missing from a lot of the small cap trades. You've had pockets of industries where actually the earnings has been pretty good. Healthcare is a good example of that. But a lot of the investment in small cap has actually been the more speculative companies with no earnings. So you see this divergence between the Russell, which has all of the small cap, and the S&P 600, which only has profitable companies. The Russell did much better last year. So I think small cap is a great place to play in terms of being able to have more diversification relative to your Mag 7 exposure. But you have to own businesses that are actually profitable, because this is a more economically sensitive space.
Well, on that point, though, Julie, I am curious just to get your general outlook. I know you're not an economist, on where the economy goes this year, because there's been a lot of concern about some potential speed bumps, if you will. And at the same time, a lot of investors trying to be optimistic with provisions from the One Big Beautiful Bill kicking in this year, maybe the potential for additional stimulus, given that we're in an election year cycle where politicians need to kind of prime the pump a little bit, if you will.
Yeah, exactly. I think it's a very noisy year, and typically midterm elections aren't great for markets. I do think that we have a lot of a sugar rush coming in the first and second quarters, thanks to the refund checks and the One Big Beautiful Bill. The only problem is we are absolutely leaving the bottom quartile, right? Because any offset that they would have had from taxes and tips, they weren't really paying taxes on them to begin with, and they're going to have the SNAPs cuts and the Medicaid cuts. So they're really going to be the ones who struggle. I think we'll hear that in earnings reports as we get to the fourth quarter and first quarter. But I think overall, it's a pretty good outlook. Most companies feel like demand is stabilizing. They feel like they have more clarity. There's a lot of opportunity for them to do more expensing in terms of their R&D. So there are good things that are baked into this economy that should be supportive, but that doesn't mean that there won't be hiccups along the way. And I think that's what people have to be ready for, because valuations are high, and that's typically when you have corrections.
Julie, always a pleasure. Julie Biel, Chief Market Strategist over at Kayne, Anderson, Rudnick, kicking us off to the close here on this Tuesday afternoon. When we come back, we're going to check in on the situation in Venezuela and talk to a key player, someone who was involved in past decisions by the U.S. to enter other countries and, of course, the ramifications for managing the fallout once that decision has been made. Richard Haass, President Emeritus at the Council on Foreign Relations. He joins us next. This is Bloomberg.
Venezuela bracing for what some are calling a gold rush after President Trump's vow to revive the country's flailing oil industry. Energy traders getting ready for talks with the U.S. government about the potential opportunities. And it's a big gamble for the president, with concerns rising that the U.S. could go on to exert its influence in other parts of the world. Joining us live to discuss is Richard Haass. He is President Emeritus at the Council on Foreign Relations and Senior Counselor with Centerview Partners. Richard, it's great to have you with us. You've said in the past few days that you're not viewing this as a regime change. You think about Delcy Rodriguez, of course, Maduro's vice president, now inaugurated as the acting president of Venezuela. How do you see her working with and that relationship with the U.S. administration evolving?
Well, again, it's leadership change, not regime change. All the other components, all the other features of Venezuelan society essentially are what they were 4 or 5 days ago. The real question, I think, the interesting one is what is the nature of any, shall we say, understandings between Delcy Rodriguez and, say, Marco Rubio, and also whether they're kept. You're going to have various forces and pressures come to the surface in Venezuela. So it'll be very interesting to see how the opposition reacts to being shut out, whether there's pushback against what is seen as a large American presence or international presence in the oil industry, whether certain groups feel disadvantaged and decide to take up arms. And the administration is essentially banking on continuity, and that could well happen. But I don't, I've learned in these situations never to assume good news.
Well, to the point on oil, you think about Delcy Rodriguez, an oil minister. She has been sort of the go-to contact for senior executives in the oil industry. Much has been made, of course, about Venezuela's oil reserves, and there's been a lot of ink spilled about what this could mean for the global oil market if you do see Venezuela's output sort of go back to the peak levels that we saw in the 70s, Richard. And I wonder how you see that evolving and whether or not some of those big ambitions, whether the timelines are realistic here.
And my own view is most of the optimism or the argument that this is going to be a game changer is way overdone. Yes, on paper, Venezuela sits on 17, 18% of the world's proven oil reserves, but the oil, as you know, is heavy in sulfur. The wells and the infrastructure are in a serious state of disrepair. This is a moment where we say there's a lot of supply out there. The fact that oil's at $60 a barrel is of it itself, is quite revealing. So it'll take time and money to get oil production up in a market that at the moment is not desperate for more oil, which, by the way, would add further downward pressure on prices. So my own hunch is, over time, the output will go up from 1 million barrels, maybe to 1.5 million, maybe even to 2 or slightly more. But this is not a game changer in a world where you've got over 100 million barrels a day.
I am curious, though, Richard. I mean, it's going to take a while before we even get to the energy infrastructure build out, if it does indeed come. There are questions, though, just about the general stability in the overall region. We've already heard from some neighboring countries, including Colombia and Guyana, have expressed a little bit of disappointment, if you will, about the U.S. intervention in Venezuela. And I am curious as to how, if you were still at the White House, how you would sort of advise the president and the other people there about how to approach the possibility that some of those neighbors might actually end up working against U.S. efforts to do whatever the goal is.
Well, again, I think the administration has to decide whether what happened in Venezuela is a one-off, which leads you in a certain direction, and essentially we're going to focus on keeping things stable there, or whether what happened in Venezuela, if you will, is step one, and now the United States is going to turn its sights on Colombia or Canada or Cuba or Greenland or you name it. And, the signals coming out of the administration are quite muscular, and my concern is if too much momentum comes out of this, if the administration starts to feel that it can't miss, it can't lose, then my sense is they'll overreach and they will trigger a reaction against them, not just in the Americas, but obviously if they move against a place like Greenland, that would have deep, deep consequences for the future viability and cohesion of NATO.
Well, and there's also issues about what the U.S. capabilities are. It's one thing to get involved in one or two countries with regards to this type of intervention, but you start rattling off the list of names that you said. I don't even know if we have the capacity to do that. And I do want to go back to your time in the administration, during the Bush administration. A lot of the concerns about our invasion of Iraq, the Pottery Barn rule, which wasn't really a rule, but certainly something that you, Colin Powell, and others invoked a lot. The idea that if you go in there and start messing stuff up, ultimately the responsibility ends up being on the U.S. government or the U.S. military to fix things.
Yeah, it's for that reason that I believe this administration has decided to limit itself, again, to a change at the top. They swapped out Maduro for Rodriguez, but otherwise they seem pretty content to leave things as they are. This is not a policy based on trying to bring the Democratic opposition to power. That would probably trigger massive resistance, could trigger a civil war. So I think what the administration is hoping is they can get the access they want to Venezuela's oil in exchange for essentially leaving most of the powers that be in place. That's the deal they're essentially working. And the question is whether that deal holds.
I am curious, Richard. I don't want to be too speculative here. But do you think that Russia had any involvement in the decision by the U.S. to take this action against Maduro last weekend?
I don't. I think the Russians are probably on one level slightly unhappy with what has happened. It's a bit of an embarrassment for them. Venezuela was associated with them. They have to be concerned about what this might mean for Cuba. On the other hand, if you're Vladimir Putin, who, by the way, a week ago had no interest whatsoever in peace with Ukraine, I think now, if anything, he feels vindicated. He sees that the United States is using force to, in this case, to get rid of a leader it judged to be illegitimate in its backyard. And Vladimir Putin goes, I like that way of thinking. It kind of works for me vis-a-vis Ukraine. So I think in the larger sense, Vladimir Putin is probably happy, as is China, also seeing the United States more involved than ever. And we're in danger. We've got to think about this, whether we want to, in some ways, voluntarily change ourselves from being a global power to being more of a regional power.
Ambassador, I always appreciate you taking time for us. Richard Haass there, who spent quite a few years at the Department of State, holding several positions, helping to shape U.S. foreign policy, now emeritus over at the Council on Foreign Relations. All right, coming up here, a downgrade from Baird on two big banks just ahead of the start of the earnings season next week. We're going to talk to the man behind that call when we come back after the break. This is The Close on Bloomberg. Time now for our top calls. Big movers on the back of analyst recommendations. We start with Lennar. UBS downgrading the home builder to neutral from buy. Some concerns here about headwinds in the home building space. Next up, let's take a look at Mobileye. JP Morgan upgrading the maker of autonomous vehicle components to neutral, raising the price target to about $13. The company citing stabilization of the auto sector as well as some partnerships that the company has with Lyft and Uber. And finally, Wells Fargo, Baird cutting the bank to underperform from neutral. The analyst saying that expectations heading into Wells Fargo's earnings next week might be a little bit too high. Joining us right now is the man behind that last call. David George is a senior research analyst covering U.S. banks at Baird. And David, let's get right to it here. Wells Fargo's had a pretty good run over the last few months, largely because of, I guess, the easing of some of those regulatory constraints. You think expectations, though, are still too high going into this print next week?
We do. Good afternoon, Romain. Thanks for having me. From our perspective, Wells Fargo is in a great fundamental position, but the stock we just think is a little too pricey here, and we're advocating investors selling the stock today in light of a valuation for Wells Fargo shares that has never been more expensive. In the 25 years that we've covered this stock, it is at 2.2 times tangible book, over 14 times forward earnings. So it's simply just a risk-reward call from our perspective. And after a great move and a great year for Wells, we think it's time to take profits.
Yeah, and I mean, you think about the performance over the past 3 years for Wells Fargo, 3 straight years of double-digit gains, up almost 33% in 2025 alone. I hear what you're saying here when it comes to valuations, but my understanding, I mean, reading your call, that the fundamentals here are actually in pretty good shape when it comes to Wells.
That's right. And I think that, Katie, the fundamental outlook and backdrop for the bank group broadly going into the new year is relatively good. As you mentioned, capital markets is very strong. The outlook for loan growth, we think, is maybe a little bit better with some of the stimulus activities that should help the economy here in 2026. So this is fundamental backdrop, and it's important to appreciate the fact that the market is not the economy, and that stock prices aren't always the same as the economy. So while we've got a constructive macro backdrop today, we think expectations are relatively high. And I guess what we're saying is the upside, if the best case scenario manifests itself, relative to the downside, if anything short of that, is asymmetric. So because of that, we want to be sellers of Wells here.
And it's kind of interesting, too. I mean, you also have an underperform, I think, on JP Morgan as well as KeyCorp here. Are there any banks heading into this earnings season that you do like?
There's several banks that we like. Some of our favorites, Romaine, are Fifth Third and Huntington, both Ohio-based banks. Both are in the midst of some acquisitions. Fifth Third is buying Comerica. As you may know, we're very constructive on that transaction. So we're buyers of Fifth Third. We also like Huntington, as we mentioned. We also like PNC. We also like Zions Bank. We upgraded Zions, if you recall, in October. I think I was on your show. The stock was down, I think, 18% in a couple of days due to a kind of a near-term fraud blip, and that's one that has rebounded nicely. But we continue to like Zions Bancorp as well.
And I mean, just to zoom out a little bit, David, and we have just about a minute left. When you think about, the big banks versus the regionals, where are you tilting more towards in 2026?
Yeah, we're definitely tilting more towards the regionals, and it's more so of a positioning and valuation setup. That dispersion between the regionals and the money centers has never been more wide. And while the money center business models are great, we just think that that's too big of a disconnect. And you can buy a bank like Zions or PNC at 9, 10, 11 times earnings relative to a JP Morgan at 15 times or a Wells Fargo at 14 times. So that's just too big of a dichotomy from our perspective.
All right, David, great to get some time with you ahead of those big bank earnings. That is David George. He is senior research analyst over at Baird. Now, coming up, is the data center deluge set to continue in 2026? We'll ask David Steinbach, global CIO of Hines, about the AI boom's impact on real estate, plus his broader outlook on the sector on the back of their new report. That conversation up next. This is The Close on Bloomberg.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Boston.
And I'm Katie Greifeld.
Did you forget?
A little bit. It's 3:30 p.m. though, and I'll never forget again.
All right, well, here we are on this Tuesday afternoon, and there's a new report out, Katie, by the global real estate investment manager Hines. And it actually has some promising takeaways on the recovery of the real estate sector, finding that after years of ongoing turbulence, the global commercial real estate sector appears to have found a stable altitude and is now primed to begin its next ascent. Joining us right now is David Steinbach. He's the global CIO over at Hines and a managing partner there. All right, let's start off that. Begin the next ascent. Really? I thought real estate's been doing well so far, right?
It's been a tough few years.
Yeah.
I think people forget that really beginning in 2022 when rates went up, that really caused a reset in the market in the private real estate. Mm-hmm. So without question, the footing feels much firmer going into this year, and we're looking forward to some good opportunities.
What's creating that firmer footing? Is that an economic story, a rate story? What's going on?
It's a blend of things.
Yeah.
Look, rates have come down some, and that has helped. There has been a real ceasing of new supply that's now several years in the making, and I think most people forget or just fail to see how important that is to the market. Every growing economy needs some new product, new supply to be coming online. There's obsolescence, economies grow, but the economics have not justified new development, so it's been completely cut off. And that problem will compound over time, and people forget how long it takes to build, deliver these projects, and so that will drive rent growth that we see as a good opportunity.
So it sounds like we're talking about living here right now, that you think about sort of where you're seeing those opportunities, that living space definitely presents itself.
Living is our number one conviction, for sure. The U.S. is about 2.5 million houses short. There have been some pockets of oversupply, but it is interesting that the last few years before this downturn, there's been a tremendous amount of new supply did come through the system, and overall occupancy for living is in the low 90s for the whole country. And there's new supply that still needs to come. So that is our number one conviction.
Well, I do want to go to this bullet point in your outlook. You write that office interest is growing, and we know that when it comes to commercial real estate, office, it's been hard for it to sort of get its sea legs under it. And tell us what is starting to shift here when it comes to that dynamic.
Well, first, when you look globally at office, it's not the same everywhere. And Europe, Asia, it's a very different dynamic than here in the United States. Here in the U.S., certainly, New York has been leading on the recovery of fundamentals, but we've seen strong fundamentals in some of the best projects in cities all over the country. That will continue to play out. The real piece that has started to come more into focus has been the lending side. And really private credit has been an answer the last couple of years, and that space is getting deeper. And so the ability to refinance some of the best projects or bring financing into deals that need capital to do leasing, that has been improving steadily. And so that really, for us, is a leading indicator into what will end up being an equity opportunity. But that'll be emerging. It's still early. It's more on the credit side right now.
Is price discovery, and I'm talking specifically on offices, is that a little bit more transparent than what it was a couple of years ago?
We've had some great trades the last, really at the end of last year. I think also people are starting to look at the spread between the cap rate, which is the rate of return for a building, and the cost of borrowing. And as lending has come back, that spread is very wide right now. And so for the best projects that are well leased, in some cases the highest rent cities have seen, in some cases for the best of the best, the dislocation in capital markets just doesn't make sense.
We've had you on the show before and talked to you a lot about sort of shifting supply chains. I mean, I guess we can maybe peg that to the first Trump administration, and obviously the pandemic. And of course, Trump coming back has sort of reinvigorated the ability, or I guess the need, for some companies to start to think about reshoring or nearshoring some things. Are we seeing a material uptick in shovels in the ground on those types of projects?
Absolutely. This is a global phenomenon, and this has been a theme that we've been seeing for several years, which is deglobalization. We've been talking about it for years, and everything that happens in the news cycle just seems to further reiterate that is a trend that we're going to see for some time to come. I think a lot of companies are looking at their supply chains, they're looking at redundancies, they're looking at where they get their goods, and it's going to require a lot of building in the next few years. And what makes that story interesting as well is that right now that the premium that you should get for development, it's hard to find. And so that is meaning that if you have a project today, you bought a project, you own a project, it is becoming increasingly scarce that we'll see rent growth come through. And so that this reshoring is also going to cause increased demand.
Increased demand. I do want to go back to something you were saying as it pertains to office. You said eventually that will present itself as an equity opportunity. And when it comes to your style of investing, when you're looking to deploy capital, do you see more opportunities in credit or in equity right now? Or does it really depend on what sort of project we're talking about?
Yeah, it really depends on the product and where. In the U.S. right now, for the most part, we've been most active on the credit side in office. Cities like New York, though, there's been some great equity opportunity and trades that have been occurring that have been very interesting, and those are starting to spread. These things they happen over time, and we're starting to see those green shoots.
So we also have to talk about data centers, of course. That was the conversation over the past couple of years. I have to imagine, yeah, but apparently, you can cool them theoretically, maybe with less intensive systems needed than maybe in the past. Anyway, so would expect that to be the conversation in 2026 as well. Refresh us on how exactly you invest in that theme, because my understanding is you're not investing necessarily in the data centers themselves, but more the land that they sit on top of.
Historically, Hines has been involved in data centers for a long time, for 30 years, and the customers were the banks, and the scarce resource was the building specifications that was difficult to achieve what the end users needed. The last few years that's shifted. The customers are now the hyperscalers, and the scarce resource is now power. And we found ourselves obviously interested in the entire value chain, but we've been most focused on powered land simply because that was where the choke point was. And being able to secure land, secure power, and be able to provide that has been where we've seen some great opportunities. that is slowing down a tad, although we're still seeing opportunities. I think that is in large part just because of some of the growth that a lot of folks were expecting. They were looking to go on offense and trying to establish, because this choke point of power is very real.
Yeah.
Nobody wanted to be boxed out.
Yeah.
And so there was an aggressiveness to get ahead of that. And the fundamental core demand there, we still see as strong, although we could, there has been a little bit of a pullback.
Are you concerned at all about potential regulatory constraints? And this gets to the power cost. There's been some great stories about just how much wholesale costs went up last year and the idea that they're going to continue to go up. A lot of this has become an election issue already, and there are going to be some politicians that are going to look at these data centers and say, not in our backyard. Are you prepared for that?
There is a dynamic that is occurring. What's interesting about the United States is the way our electric grids work. It is a rather decentralized a collection of grids, really, that do give the different grids opportunity to compete in many ways for that. There will be some areas that supply will be cut off. Other areas are welcoming it, and so I think that you'll just see the supply follow.
David, I'm waiting for that big development where it'll be like an assisted living facility on the ground floor, data center in the middle floors, and like office on the top floors.
You never know.
Someone's working on that.
Who
right
else?
now.
Put a Starbucks and a Whole Foods in there, and you got it all there. David, always a pleasure.
Thank you.
David Steinbach, managing partner and global CIO over at Hines. And we're going to continue the conversation about what's been going on in AI and with those data centers. A bit of a cool down based on some remarks from NVIDIA CEO Jensen Huang on stage at the CES conference out there in Las Vegas. We're going to check in with Caroline Hyde, who's there on the scene when we come back after the break. This is The Close on Bloomberg.
This entire system is twice the energy efficiency, essentially twice the temperature performance, in the sense that even though the power is twice as high, the amount of energy used is twice as high, the amount of computation is many times higher than that, but the liquid that goes into it's still 45 degrees C. That enables us to save about 6% of the world's data center power. So that's a very big deal.
That was NVIDIA CEO Jensen Huang revealing new technology in yesterday's CES keynote that can cut back on the power required to cool his company's indispensable AI chips. That sent shares of data center cooling companies, including Johnson Controls and Trane Technologies, sliding after those remarks. And those are today's stocks of the hour. Joining us live from CES is Bloomberg Tech co-host Caroline Hyde. Caroline, so give us some context here on these comments, because Jensen Huang was talking specifically about those next generation Rubin chips here.
He is, and he's having to tell specifically the market that these are more efficient. These actually, by running them, will save you money versus Blackwell, because the desire here is to provide ever more compute power, but with a less of a resource impact. Remember, Romain's been reporting on it so well throughout some of the election cycles that this is becoming a votable issue. The communities are worried about data centers coming into their backyards, the impact on energy, the impact on prices, the impact on water and utilities. So no wonder Jensen's trying to answer that. Of course, pity those that try and make cooling equipment that then fall on the back of the fact that you won't need chilled water to do so. But in the same breath that he will have an impact on a data center cooling stock, he will then send SanDisk and other memory storage companies flying higher, because he's saying that is where is underserved in the market right now, and the ever more stressful need for memory to be using and designing this AI architecture and to be able to train the models. So really interesting impact he has, not only in his own stock, which of course he talks up in many ways. We've been hearing about the China potential here, the H200s, the feverish work that the government is doing there to boost that sort of a demand in the long term.
Well, I am curious, Caroline, because we talk about, look, I understand Jensen Huang is going to be bullish on AI. We heard from Lisa Su as well over at AMD. Still bullish, though some skepticism by investors. And in the middle of all this, we had some breaking news on the Bloomberg terminal about Elon Musk's AI venture, XAI, raising $20 billion, more than what it had sought to raise. Is that sort of confirmation, maybe, of what Lisa Su and Jensen Huang have been saying?
Well, it's certainly interesting that NVIDIA is a strategic investor in that particular round. It had been previously reported by Bloomberg that maybe they contribute up to much as $2 billion. Now, remember, this is deemed a circular deal that puts so much anxiety in the markets because these are companies like NVIDIA putting money into the end demand of their GPUs. This will go for xAI to be able to afford the next amount of GPUs it needs in Colossus 2. That's his massive data center that's building out over in Memphis. So it takes money from NVIDIA to be able to commit to buy more NVIDIA chips. But remember, there's a lot of others involved in this particular round. And you see Valor, which has long been a supporter of Elon Musk's endeavors. You've got MGX, which has long backed xAI and also is in Anthropic and OpenAI as well. That's the Abu Dhabi investor. But a lot of this is really cementing what we've been talking about. Is this potentially a hype cycle?
All right, Caroline, great to get some context with you out there at CES. That is Bloomberg Tech co-host Caroline Hyde.
You know what we call that, Katie Greifel?
I was hoping you'd tell me.
Ouroboros.
Ouroboros.
The serpent
that snake.
eating its tail.
It just never stops eating itself. Coming
I practiced that the whole vacation.
The whole vacation.
I said 2026. I have to be able to pronounce your keyword.
It's the word of the year. The closing bells are up next. We'll take you there with Veronica Willis. This is The Close.
What you talking about?
You see this divergence between the Russell, which has all of the small cap, and the S&P 600, which only has profitable companies. You know, the Russell did much better last year. So I think small cap is a great place to play in terms of being able to have more diversification relative to your Mag 7 exposure. But you have to own businesses that are actually profitable because this is a more economically sensitive space.
Julie Biel over at Kayne Anderson Rudnick kicking us off to the close. Just about 50 minutes ago, a discussion about the outperformance over the last couple of days involving the Russell 2000, the small caps, the cyclical stocks relative to the rest of the market. But right now, Katie, everything, all the major indices right now are solidly in the green.
Absolutely. Green across the screen. The S&P 500 looking to close at a record high, higher by about 0.7%. You can see the NASDAQ, too, also enjoying those gains. I put crude oil on the board because it was so interesting yesterday to see it actually climbing, and today you can see it's more than reversing some of those gains. Yeah,
that was kind of confusing, right? Because you're like, well, if they're going to produce more oil, wouldn't that depress prices?
Supply goes up, price goes down.
But I have a feeling we're going to see a lot of oscillations over the next few weeks and months as we try to figure out what the next steps are here.
Absolutely. And gold there, I figured I'd put that up because it's very much a risk-on day across markets, but yet again, similar to 2025, seeing gold catching a bid despite all of that risk appetite.
A relative risk-on start to 2026 and some big questions as to how long, if at all, that continues. Veronica Willis joins us right now here in Studio 2, Global Investment Strategist at the Wells Fargo Investment Institute. Great to have you here.
Great.
Let's talk about this, and really we kind of have to put this in context. I mean, we're basically more or less 3 years into a bull run, depending on how you want to measure here, and a lot of questions about valuations and whether public equities have maybe gone a little bit too far or maybe not far enough. And I'm curious as to what your general outlook is for the broader market this year.
Yeah, we're thinking that equities still have a little bit of room to run. We're not expecting another double-digit year like we saw last year, but still a pretty good year for equities and risk assets overall.
What do you think actually supports further gains? I mean, I know ultimately it's always going to be earnings, but what feeds into that gives you the confidence that we might actually see a better performance this year?
The earnings is a big part, but really underpinning that is the economy. We're thinking that 2026 is going to be a good year for the economy, and even the data that we've seen so far is indicating that Q4 might be a little bit better than what we were expecting, what the rest of the market was expecting, and I think that strength in the economy is really going to drive equities this year.
So how does that translate into the portfolio then? I mean, is that a blanket bet on equities, or do you see certain industries, certain sectors that really stand to benefit here?
We think that it's going to be still a volatile year, and so that makes us kind of lean into quality a little bit more. So we like large cap over small cap still. We like mid cap over small cap, and we do still like the U.S. over international. International had a great year last year. I don't know if that'll be duplicated this year, but we think with the U.S. economy leading the global economy, that should lead to the return of the U.S. equity market taking leadership.
Well, talk to us a little bit more about that view on small caps, the fact that, you would favor size over the little guys, because as you saw, we opened up the show with Julie Biel, who sort of took the other side of that trade, and we've heard a lot of optimism about small caps and their potential for maybe some sustained performance here.
Well, I think even if small caps perform well, I think large caps are going to perform better because there's a lot of uncertainty out there, and those larger companies just have more cash on the balance sheet to be a lot more nimble than some of these smaller companies. So it leads to an environment where we expect the large cap to do better than small cap, but not necessarily going to be a terrible year for smalls.
I am curious, though, about the AI trade overall, because that has been obviously the main driver over the last 3 years. And some questions here, not so much about whether the AI trade is over, but the idea that people seem to be rotating into other pockets of tech, if you will. I am curious as to whether you think that is a wholesale move or whether that's just more tactical.
I think it's a smart move for investors to think outside of those major names in tech when playing the AI trade. For a long time, we've liked industrials, we've liked utilities, because those are going to be big players when it comes to data centers and all of this infrastructure needed to fuel AI. So any kind of diversification you can do, but still playing into that AI story, we think is really smart. Tech is such a huge weight in the index. So even if you're market weight on tech, you're going to perform with the market. No need to get over your skis in tech, and look at some of those other areas, maybe some of those lesser known names to play that AI trade.
It gets to this idea, though, as to how do you find that? Do you do that on a individual basis, meaning stock picking? Do you look for an ETF or some broad market index to track this? What do you do?
I think focusing in on that sector level, thinking about those ETFs is a really smart way. It's really difficult to pick those specific names. You know, any bit of news can really change the story for any particular company. But when you're focusing in on the sector overall, you're getting that exposure to any of the names within that sector that are doing well.
Yeah, it's really interesting. This conversation reminds me again of what we were talking about at the top of the hour. You think about one of the most read stories on the terminal today. It's what we're seeing in data center cooling stocks, really sinking as a group after we got those comments from Jensen Huang. And there's this idea that, you know, you want to find the next wave of the AI trade versus just the picks and shovels. A lot of folks sort of flocked to these cooling stocks thinking that was going to be an important part of the build out. Maybe that's being questioned right now. And I wonder, you know, how you think about that when trying to figure out where this AI trade is going to go and how it's going to actually broaden out.
Yeah, I think just broadening out a little bit, even outside of just choosing one particular stock or one particular type of stock, is a really smart strategy. Because if you're thinking about those sectors, industrials or utilities overall, instead of just focusing in on one industry within that sector, you're going to get a little bit more time to really see what's fleshing out, who's really going to be the winners there.
And before we let you go, I do want to talk about how the bond market sort of factors into this entire discussion. A lot of focus on the Fed, a lot of focus on how the long end of the Treasury curve is sort of going to react to maybe a few more Fed cuts coming down the pike. So far, I mean, you take a look at it and yields at the long end have sort of remained where they are. How does that factor into your view on equities?
Yeah, I think on the long end of the curve, the yields are really focused on where they're thinking economic growth is going to go as opposed to what the Fed might do. And it's part of the reason why we actually like the intermediate portion of the curve, because there's less risk on that long inside with whatever goes on with economic data, and then less risk on the Fed's end, whether they cut more or less than what the market's expecting. And so that's where we'd focus on for fixed income. But from a fixed income to equity perspective, we do favor equities right now. We're pretty positive on that risk on trade. So, you know, pulling out of that fixed income space to add a little bit more to equities is a pretty smart move right now.
Veronica, great discussion. Veronica Willis, global investment strategist at Wells Fargo Investment Institute. And just to kind of circle back to what she talked about with regards to the economy being important, we're actually finally getting back into a normal economic calendar after the disruption from the government shutdown. And we get ISM services tomorrow and, of course, a big jobs report on Friday.
Absolutely. Yeah, it's going to be nice to not have to sort of caveat every single data release. And certainly you think about that labor market print coming up on Friday. It's going to be quite informative for the Fed as we try to figure out inflation versus the labor market, which is more urgent at this juncture.
Absolutely. That was a parlor game in 2025. It appears to be the same game here in 2026. A full breakdown of all of today's market action starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here with Katie Greifeld, taking you through to that closing bell. It's a global simulcast. Carol Masser, Tim Stenovic, they're in the radio room. Welcome to our audiences across all of our Bloomberg platforms, including our partnership with YouTube. Green across the screen, for a third straight day here. Carol Masser, maybe a good start to the year, but of course, we're only 3 sessions into it.
Only 3 sessions, although Tim keeps counting them down day by day in terms of the market trends.
Well, it's only 3, so it's quick count.
It's a quick round.
Soon we're going to get to, it's going to be a number where I can't count 2, but we're in the single digits.
When you get to 11,
I'm still in good shape, guys. I'm still in good shape.
But we're talking about possible records, right, on the S&P and the Dow Jones.
S&P is at a record high today.
Yeah, I mean, kind of interesting, despite some of the geopolitical concerns. And
Katie's favorite.
What's Katie's favorite?
The Dow.
The Dow.
The price
I know.
Oh, gosh.
Industrial average.
I thought you were being, honest.
We were just talking to Vance Howard over at Howard Capital Management, and he brought up some technicals when it comes to exactly what we're talking about here. And he basically said, what is it, Carol, for the first 5 days of the year look how skeptical Romain is. He's not a technicals guy. If the first 5 days of the year are in the green, then there's a more than 85% chance that it's going to be an up year.
Okay.
All right. It's a little bit like astrology, which I am into.
Agree.
But
I completely agree with you.
Yeah.
Maybe we should check and see what
my gosh, you've offended all the
says.
market technicians who watch this show. But we love you guys and women.
Ouch. Ouch.
Yeah.
Carol loves technicals. You love technicals.
I love technicals.
Yeah. A nice read on the market here. And actually, in all seriousness, of course, those technicals, most cases are still tied to fundamentals as well here. Overall, though, you have investors starting off 2026 with a relative degree of optimism. The Dow Jones Industrial Average going to add more than 400, almost 500 points on the day, up about 1% at a fresh record high. The S&P 500 looks like it's also going to close out the day at a fresh record high, adding more than 40 points, or about 0.6%. The NASDAQ Composite adding 151 points, or 0.7%. But guys, we got to take a look at the cyclical space here. Once again here, that is the outperformer. The mid-caps up about 1.5%. Transports up 1.7%, and the Russell 2000 up 1.4% here on this day.
Yeah, some significant outperformance there. I'm going to go back, though, nonetheless, to the S&P 500. And you've got most names, Katie, in the index higher. 379 to the upside in the S&P 500, 123 to the downside, 1 unchanged.
Carol, the circle tells the same story. You take a look at it. 9 out of 11 sectors in the green, led by materials, healthcare, industrials. You can see also the tech sector lit up there. In terms of what didn't perform today, energy was your biggest loser. The energy sector was one of the outperformers yesterday. Today, down about 2.8% as a sector. Communication services also in the dumps, down about 0.5%, Carol.
All right, I want to go to a batch of names. SanDisk, Western Digital, Micron, Seagate. Top 4 gainers we've seen in the top. They were actually top in the S&P 500, and we've seen them leading the way once again today. SanDisk, you can see it's up 27% in today's session. Western Digital up 17%. You've got Micron up about 10%, and then of course you've got Seagate up about 14%. Seagate alone, #1 gainer in the S&P 500 last year after that strong start, soaring. Why are these names all higher? NVIDIA CEO Jensen Huang saying memory storage chip market is unserved market. And so we did see SanDisk hitting a record on high volume. So really some outperformance if you look at those names in particular. And then just real quickly for something different, OS is the ticker, OneStream. It's a $5.6 billion market cap company. Shares soaring today, up about 28% after Bloomberg News reported that buyout firm HG is buying the maker of financial software company and taking it private. Price $6.4 billion, as I mentioned, or I didn't mention, $6.4 billion, $24 a share. That was a 31% premium. So yeah, a high flyer there.
I love the 5 gainers.
I know, 5 for 1.
That was pretty cool.
4 for 1.
I got 2 decliners. You're making me look bad, Carol. Trane Technologies falling 2.5%. We saw a lot of cooling systems makers fall today. This after NVIDIA CEO Jensen Huang raised fears about demand for their products from data centers. Johnson Controls fell as much as 11%. Modine Manufacturing fell as much as 21%. Carrier Global also was among the worst performers in the S&P 500 today. Jensen said it's possible to cool racks with the company's next-gen Rubin chips using water at a temperature that does not require a water chiller. And that's why we saw shares of these companies fall today. Also, shares of America's largest credit reporting companies falling on the day today. Shares of Equifax falling 3.9% after Federal Housing Finance Agency Director Bill Pulte called out the firms for raising prices. Here's what he said in a post on social media, quote, "I do not understand what the credit bureaus are doing with their pricing. They are inviting a lot of scrutiny that is only intensifying by the day." This comes after the Mortgage Bankers Association said in a letter to Bill Pulte that its members are facing another significant increase in credit reporting costs for 2026, Romaine.
All right, let's take a quick, some breaking news here, Tim. This on Mobileye. This is the maker of kind of autonomous vehicle components, sensors, software. They're going to buy the humanoid robot maker Mentee for $900 million. This is now crossing the Bloomberg terminal. The company has confirmed it, saying that they expect to close out the transaction in the first quarter of 2026. Of that $900 million, about $600 million of it will be in cash. The rest will be in Mobileye common stock. Those shares, which had rallied about 6% in the cash session, now up 7% in the after-hours trade. Let's take a quick look at Treasury yields, because we actually did see a lot of activity there. It may not look like much on your screen with those moves, but the key here is that 10-year yield, and take a close look at that here at 416.52 and change here. That's a key milestone, the highest level relative to 2-year rates in almost 9 months. And that's a big signal that investors are anticipating more rate cuts from the Fed, of course, starting at their next meeting at the end of January.
All right, looking forward to that, indeed. All right, guys, that's a wrap across platform, radio, TV, YouTube, Bloomberg Originals. Of course, Katie and Romaine continuing there on The Close on TV, and Tim and I continuing on Bloomberg Business Week Daily right here on Bloomberg Radio. We'll see you again, same time, same place tomorrow.
And our coverage continues here on Bloomberg Television. A conversation up ahead here about what's going on in the world of candy. Taking a look at Hershey's shares and what has been a bittersweet year for chocolate makers as cocoa prices are stabilizing, yet they're still holding near some of those record levels. We talk about the high costs leaving an opening in the candy market for, well, maybe other types of sweets, like gummies. Joining us right now, I'm pleased to say, is a relatively new CEO of Hershey, Kirk Tanner, and NBA legend Shaquille O'Neal. They're teaming up for Shaqalicious Slams, a new hoops-inspired candy. Shaq and Kirk join us right now here exclusively. Hey, guys, great to have you here. I'm going to start with you, Kirk. Being the new CEO, and more importantly, the idea that at some point you, or at least your people, reached out to Shaquille O'Neal and did what I think is probably the first time I can remember Hershey's doing this, entering an IP-based partnership with a big-time celebrity like this. What was the impetus for that?
Look, I think Shaquille is a terrific partner. I think that bringing great brands to life and creating great moments and brands through a partnership like the one that we have with Shaquille was the genius behind this. It gives us the opportunity to connect with culture, to co-create. Shaquille has been such an important partner in creating. He's been in our R&D tech center. He's hands-on. He's just the partner that you could create something really magical with. And we brought that to life, and it really is connected to culture. Consumers love this. This is driving growth for both of us. It's truly a win-win partnership.
I am curious, Shaq, about this idea of, what this brand is supposed to be and how it sort of differentiates itself from some of the other, gummy-type candies that are out there on the market.
Well, I've always, considered myself the ambassador of fun. Kirk is being modest. Hey, Kirk, me and Kirk go way back to Kirk and his Pepsi days, but, Slams is like the newest innovation from my Shaqalicious gummy brand. It's kind of a play on Slam Dunk. It's 3 crunchy gummy balls and a sour mango ring. And no bite ever has to be the same because you can mix and match it. And, Shaqalicious Slams now available nationwide, but, Hershey's is the Shaquille O'Neal of all candy business. So when, we met about the idea, like Kirk said, I was hands-on. They accepted it, and we just wanted to do something that's just different and that's just fun.
So, Shaq, at this point, you have the XL gummies. Those launched in 2024. You have XL Sours. You also have sneaker-shaped gummies, and now you have Slams as well. And I am curious, why gummies? Why not go with chocolate? What led you specifically to this form of candy?
Because, when I met with Hershey's about different ideas, they said, well, what was your favorite candy growing up? And I told them the Gummy Bear. And they said, what's the Gummy Bear? I said, well, when I was in Germany, that's what they pronounced it, Gummy Bear. And Kirk and the team was like, you know what? Let's do gummies. And that's how the idea came. You know what? A big, sexy Shaq chocolate bar would be a great idea. Thank you, young lady. I'll cut you in.
So there you go. Maybe we can work out a revenue share. But Kirk, I do want to ask, when it comes to gummies inside Hershey, do you plan to really explore that and lean further into that as a core category, given that, you know, as Romaine mentioned, you take a look at cocoa prices right now, they are starting to stabilize.
Yeah, I think it's important to think about the total portfolio and have the breadth of the portfolio. Sweets, which gummies fits into that subcategory of confection, is growing and important to consumers. This is the right place for us to grow our portfolio. And this partnership really lends itself to connecting to culture and, you know, creating this winning brand together with Shaquille. This is the right, you know, portfolio management for us, for sure. One, consumers are looking for these things. They're looking for this moments of fun. It's playful, and this delivers on that.
You know, it's funny, Shaq. You know, you mentioned your long-standing relationship with Pepsi. I think you signed on with Pepsi Cola. I don't know if I think it was your rookie season. Certainly several years ago. You're a much older man now. You still look great. But I am curious about how you sort of maintain these types of business partnerships. I mean, we're talking what, I don't know, 30 years now.
Yeah, 30 years. But you know, you mentioned the word partnership. I tend to focus on relationships. You know, for me, this is not about money. It's just about, you know, having a relationship, doing something that's different, doing something that's fun, and you know, I've been, you know, lucky enough to, you know, still be able to, you know, have these type of relationships. I remember when, you know, they said that, you know, Kirk was going to be the new CEO. I was like, I already know Kirk. He's a great guy. You know, we had great times at Pepsi, and he's the right man for the job, and he's definitely going to take it to the championship level. We're already, you know, a great company, but having a guy like Kirk, he's going to take it to the next level.
So, Kirk,
I'm happy to be in a partnership and a relationship with Hershey's.
So, Kirk, I am curious as to like where you want to take Hershey's. Obviously, we think of Hershey's first and foremost as a chocolate company. Obviously, you have non-chocolate products, you know, like the popcorn and Twizzlers and a couple other things I'm probably forgetting. But there's been a lot of talk about, with the increase in cocoa prices, the idea that there might be more of a shift to gummies and other things that might be a little bit more economical in terms of producing, as well as more economical in terms of how you price it. Do you see Hershey's expanding further into the non-chocolate space?
Yeah, look, we have a lot of passion around developing the sweet space that is led by, you know, the Shaqalicious portfolio. That's really important. We also have a salty portfolio that you mentioned. We also have Dot's Pretzels, we have Pirate's Booty, and we just acquired Lesser Evil. So that gives us strength in the portfolio and allows us to have more occasions with consumers. So I think that's really important to have that breadth. And look, the core of our business is critically important. We're never going to take our eye off the core. We'll continue to grow that, but there are new growth terrains for us, like this partnership, that allow us to go after and bring new consumers into our portfolio. And that really is the game. Hey, if I could just 2 seconds on Shaquille's partnership, I just want just to reflect on how Shaquille has jumped into the Hershey community. He's been at the Milton Hershey School. He's been to our tech center. Yeah. He's been to the Hershey Park. He has been a part of our community, and I just want to give a shout out. That's the kind of partnership. That's why people partner with Shaquille, because he is roll up the sleeve kind of partner.
Was he involved at all in like the taste testing or developing of these? I'm going to taste one of these live on air and let you know, Shaquille. Yes. Wow, it's a lot of different shapes in here.
Thank you.
Pick your favorite.
All right, it's an orange one. If anyone sees it, matches my little.
Looks like a basketball.
That's good. I would dunk this.
That's a smile.
Yeah, there you go.
Thank you. Oh, I like that. That's good. I would dunk this. I like this. Kirk, I just came up with a fabulous idea.
You got a good idea?
Yep. Shaqalicious popcorn. It's my face as the kernels. And as soon as you put them in the microwave, my face pops and turns into a popcorn. Think about it, Kirk. Let's do it. Shaqalicious popcorn.
Let's get to work. Let's get to work.
Yep.
All right. Well, we've got popcorn. We talked about Shaq chocolate bar. So really, a lot of organic idea generation going on in this interview. Kirk, I do want to ask a little bit about GLP-1s, because of course that has been the talk of the town when it comes to healthcare and when it comes to just the broader conversation about these weight loss drugs in society. And I know that you recently took over the helm helm of Hershey, but how do you think about potentially future-proofing the business against these weight loss drugs becoming even more a part of the fabric of society?
Yeah, let me tell you what we're seeing here. We're seeing a real resilient category with confection to start with, right? Through GLP adoption, we're obviously looking at it every day and studying the insights behind GLP-1 and the behaviors of consumers. But you have a resilient category with confection. It really is an occasion-based category. So consumers use it for moments of celebration. They use it for reward. They use it for social connection. They use it for playfulness. Just similar to the portfolio that we've launched with Shaquille. That is, gives us the hope that you have sustainable growth platforms. Now, to play offense, you continue to stretch your portfolio. We have a pipeline of innovation that's consumer-led. We have solutions that broaden our portfolio and our reach, and we leverage our capabilities at retail and our execution, all to deliver what consumers want in the face of these challenges. But I feel really confident where we are and where our portfolio is and where the category is overall.
And Shaq, I'd love to hear your thoughts here as well when it comes to GLP-1s. I know that your friend and your colleague, Charles Barkley, for example, he's a paid brand ambassador for the telehealth platform Ro. I see his ads in the Path Train all the time, which also offers GLP-1 treatments. Have you discussed this? Has he tried Shaq's Lambs?
Well, he hasn't tried Shaq's Lambs. Next time we go to work, I'm going to just take a handful and just make him eat it. But, when it comes to, GLP-1s, I think, to each his own. And I just would like people to consult a doctor or physician, before they do such things. And that's my take on it. I'm not here to say it's good or it's bad. Everybody that, wants to go through a certain journey should always involve their a physician or their doctor.
Well, I am, Kirk, onto Katie's point, though, about GLP-1s and how that maybe reshapes the way we eat and the idea that, a lot of sugary stuff, salty stuff goes by the wayside. What changes do you plan to make longer term to make sure that Hershey's business is protected if that trend does continue?
Yeah, we continue to innovate. I'll talk about a few solutions. One, portion control is really important to GLP-1 users, and we offer a broad portfolio of portion control. Another reason we've stretched into salty, we're in permissible salty categories like popcorn, like pretzels. Those give you it. We're also building a protein business behind Fulfill and our One platform. Those give you the confidence and the breadth in the portfolio to be in as many occasions as we can with consumers. That connection to consumers is really important. But I'll just reiterate, too, what we're seeing in the category. When you study categories in retail and you look at what consumers are eating, the confection category has been very resilient in this space.
Yeah, absolutely, and it has. And there's also a very competitive space, too. And Shaq, one thing I am curious about, too, I mean, through your entire career, you've been associated with a wide variety of brands, and not just as a spokesperson, but taking investments. Obviously, Papa John's is probably one of your more famous ones, Five Guys, Auntie Anne's. I know I'm forgetting a few others as well. I just found this out today. I don't know why I didn't know this, but you're one of the largest shareholders in Authentic Brands, which is effectively now the parent company of Reebok. Is that true?
Yes, sir.
And I'm just told that one of your friends, one of your colleagues, Kevin Hart, the comedian, is now a part of Authentic Brands as well. Did you bring him in?
Yes.
Okay. Why?
Me and Kevin has always had intimate conversations on how to grow portfolios and how to, build legacy. So, I introduced him to Jamie Salter, and, we just, started talking business. And now Kevin is partner with ABG, and we welcome with open arms.
Do you think he can maybe get in a gummy line with Hershey's as well?
That's up to Mr. Kirk Tanner.
A lot of ideas today.
Certainly. Yeah. You guys will be glad you came on here. This is like it's like a brainstorming session.
Yeah, not
it's our
just an
favorite show,
interview.
brother.
Kirk, I do want to ask a little bit. You talked about Hershey sort of expanding into other categories beyond chocolate. Gummies, obviously one of them. As you mentioned, you have salty snacks as well. I know that Hershey has also been transitioning to natural dyes as well, and I'd love to hear how that's going, because my understanding is you use a natural dye and maybe the candy itself is less brightly colored than it might have otherwise been.
Well, the R&D is getting a lot better on that, I would say. And we made this commitment last year to be out of artificial colors by the end of 2027. So that's our commitment, and we're working towards that right now. And we're doing the R&D to deliver that exceptional experience for consumers. That's our main focus, is to deliver our commitment with a great consumer experience for our brands.
And what is behind that push to, transition a bit to natural dyes? Is that basically following consumer demand? Did you see that basically desire for people to have less processed ingredients, or what is actually driving this push?
Yeah, it's always through the lens of the consumer for us. And yeah, if you have the opportunity to improve your product, deliver a great experience for consumers, that is the mark. But we do everything through the lens of the consumer.
Is there a sense, Kirk, I know you've only been on the job for, about 5 months or so. Yeah. Is there a sense here that, what you can do with Hershey's, obviously one of the most iconic American brands of all time. Is there a sense here that you can meaningfully grow the company? And I'm looking at this from the investor perspective with regards to not only revenue growth, but obviously margin expansion and profitability. Yeah, this is a sustainable long-term growth company. I would tell you that for and foremost. You have a robust portfolio where you have brands that consumers love. We have pipeline of innovation, and we have executional excellence with our retail partners. And I say the combination of those things give us the ability to outmarket and out-execute our competition and drive growth with all those things that do that: core growth, innovation, and a pipeline for the future. We are a sustainable growth company. We've proven that. That's been our legacy. There's been a few headwinds like cocoa and things like that, but we're overcoming those things and growing our business sustainably. Shaq,
let me add.
Go ahead.
And let me add to that. Kirk Tanner is the right man for the job. I've been in the business a long time. He's highly respected. He knows what he's doing, and I'm glad to be in partnership with him. And I look forward to taking out our competition and continuing to do fun things. So we're happy that he's in charge, because he's going to be Cooper Flag, and I'm going to be Kyrie Irving, and we're going to win this championship.
All right.
Thank you.
Go on.
No, I'd be happy to do that.
All right.
I got your back, Kirk. Me and you, baby.
Same.
We're
having a lot of fun.
Larry Bird, Magic Johnson, Bob Cousy, Bill Russell. Yeah.
All right, there you have it. Well, I can't thank you both enough for your time today. Really appreciate the conversation. That is Hershey CEO Kirk Tanner, as well as NBA legend Shaquille O'Neal. Meanwhile, Romaine, we did get some breaking news during that conversation.
Yeah, taking a look at shares of MicroStrategy, up 8% in the after-hours trade. MSCI, this is, of course, creates a lot of the benchmark indices for public equities. Remember, there was a big debate as to whether to include some of these digital asset treasury companies like MicroStrategy in their indices. The thought was that they would not allow them to be in those indices, that they would exclude them. We're now learning that MSCI has determined that they will not exclude any of those names from their indices. Now, they're not actually saying that they will put them in anytime soon, but they're, at least for right now, saying that they will implement increases in the number of shares, that they will include, when necessary, any of the companies that meet the standards, and they won't exclude on a blanket basis any of these digital asset treasury companies. That could be a big boon for MicroStrategy and a few others.
Well, it also potentially removes a big risk here, because the potential that they could be booted out of some of those indexes was one of the big reasons why you saw shares decline by about 48% last year. And really, it was behind a lot of the pressure that you saw in the latter months of the year. It makes a lot of sense to see this pop after hours, since that was one of the key risk events. And I would imagine that this would be welcome news for some of those other digital asset treasury companies as well. But coming up next on The Close, NVIDIA CEO Jensen Huang sitting down with Bloomberg Tech's Ed Ludlow earlier today, what he revealed about the runway for Rubin and what's next for the world's most influential chipmaker. That's next. This is The Close. NVIDIA CEO Jensen Huang sitting down with Bloomberg earlier today alongside Siemens CEO Roland Busch, announcing a new partnership to integrate AI tech into Siemens operations. Now, this comes on the heels of Huang's keynote yesterday, where he unveiled NVIDIA's new AI tools and talked up demand for its Rubin chip. Take a listen to some of the highlights from his interview with Bloomberg Tech co-host Ed Ludlow.
From Hopper to Blackwell, we increased energy efficiency by 10x. From Blackwell to Rubin, we increased energy efficiency again by 10x. And that translates directly to our customers' revenues, because in the case of an AI factory, whatever factory size you have, you're limited by the power. In order for a new industry to emerge, you need energy. And so I think it's safe to say that we wish we had more energy in the United States. Europe wish it had more energy. I think the world all wish we had more energy. And so we have to invest in all sorts of different forms of energy. Well, the memory bottleneck is severe, but we're fortunate to have worked with all, first of all, NVIDIA is the only company that works with all three of the HBM suppliers. And all three of them are major customers and major suppliers of us. And so we have the good fortune of working with them for a very long period of time, and we've got things all planned out.
And that was Jensen Huang alongside Siemens executive there, is talking about their partnership, but really, quite frankly, Katie, talking about kind of the future of AI and this idea that they're still pretty bullish on what they see as not only insatiable demand, but the idea that the computing capacity, the power capacity, all these capacities haven't even caught up yet with existing demand, let alone what they're projecting as far as demand, 5-10 years out.
And that's been the story, right? Especially when it comes to NVIDIA, that demand is still outstripping supply. It'll be interesting to see at what point do those two actually start to align. But certainly some interesting comments. We heard a lot from Jensen Huang over the past couple of days.
Yeah, and he actually had some interesting comments, too, here about the various chips that they sell, the idea that some of them might become obsolete. He talked a lot about cooling efficiency, becoming more efficient, which, of course, benefits him, not necessarily the data center cooling companies. We're going to talk about that a little bit more when we come back after the break. Stacy Rasgon, analyst over at Bernstein, is going to join us to give us his reaction to what we heard from Jensen Huang and company, as well as Lisa Su out there at the CES in Las Vegas. All right, well, yesterday, NVIDIA opened up the 2026 CES show in Las Vegas with the CEO, Jensen Huang, on stage touting the company's AI forecast. Today, he sat down with Bloomberg for an interview and said that his new chips would be 10 times more powerful than their predecessors. Joining us right now for a reaction to Huang's statements is Stacy Rasgon, senior analyst of U.S. semiconductors and semiconductor capital equipment at Bernstein Research. All right, Stacy, I never know whenever I hear Jensen Huang talk how much of this is hype and how much of this is substance. I feel like it lends a little bit more towards substance today and yesterday.
Yeah, Jensen is certainly not one to shy away from hype, but I mean, a lot of the things they've talked about in terms of the technological advancements of their parts have very much been substance. And I think this is the case. The biggest surprise we got from the keynote yesterday, I think, were some of the data points around Rubin. That wasn't something that we were necessarily expecting at CES. And they said two things. One is that it's in full production, which clearly means that the second half ramp that they've been talking about seems well on track. There were some worries about that. Seems like it's well on track. And then the other is the specifications and the improvements versus their prior generation Blackwell. And again, if Jensen is correct, the thing looks like a monster, right? So like that looks, I don't think it's, I'm sure there's always a little bit of hype there, but yeah. This looks real, I think. I think this is going to be a pretty good year for NVIDIA. The cooling aspect of this is obviously caught everyone's attention, and obviously that could be a game changer for the companies that are using these chips here. When you look at that technology, Stacey, is this something that's very proprietary to NVIDIA, or can it be replicated by AMD or any of the other companies? Which cooling tech you're talking about? He was talking about using higher temperature water to cool the chips.
For the Rubin chips,
So this is, and you're right, it whacked the cooling space, and I don't cover that space. This is an area, actually, I need to dig in a little more while I'm here, because I thought it was very interesting. He talked about using, I guess it was effectively hot water. It was a 45 degrees Celsius, which is like 113 degrees Fahrenheit, to cool these things, which I guess he was suggesting that you need a lot, maybe a lot less need for chillers. So I don't know if it's groundbreaking or not. I don't know if the moves in the stocks that we saw today were warranted or not. I used to be a chemical engineer. I feel like I need to pull out some of my old heat transfer work and do some calculations. Like I'd love to learn a little bit more about it while I'm here.
Yeah. Absolutely. Well, keep us updated on what you find, since there's a lot of existential questions being thrown around when it comes to some of those cooling names. But when it comes to NVIDIA, it was interesting to hear some of the commentary around China, what we're seeing when it comes to H200 exports. What did you make of that?
Yeah, you bet. So, I mean, they've now looks like they're going to be allowed to sell the stuff. So it sounds like they're still working through some of the requirements, both with the U.S. government as well as with China. And they talked a little bit about this at the Q&A that they held yesterday. The demand, I think, is there. It's clearly there. I think they'll sell as much of that stuff in China as they are allowed to sell. So I don't know how much that is at this point, but I think they did a good job. They zeroed China out of the number, so whatever they get is upside. And I think the demand for those products, especially the H200, the higher end stuff that they may be allowed to sell now, demand should be very, very strong. They also said something at the Q&A yesterday around supply. What they said is they've got, it sounded like effectively dedicated supply by region. I actually asked a question at that, which was, to supply China, do you have to starve the rest of the business? Basically is what I asked. They said no. It sounds like they'll be able to supply China once they work through all of the dynamics around the licensing and everything else.
Well, you make an interesting point that in your view, the demand is there in China for some of these NVIDIA chips, because one of the concerns out there was that, China's homegrown chips were basically at the point where they could compete with NVIDIA's products. It sounds like you're saying not exactly.
I mean, yes and no. So they have chips that can compete. Now they're not as good. What China has in surplus, though, is power. And this gets to what Jensen was talking about on your show just a minute ago. China, like what they've effectively been doing is taking less efficient chips, but building massive clusters to build up the compute capacity they need, because they can always throw another coal plant at it or whatever. They've got power to spare. That being said, the chips that they do have are not nearly as efficient because they're forced to make them on substandard semiconductor manufacturing processes. So it's not something you really want to do. And the other thing that NVIDIA has is ecosystem software and everything else. And there's a very strong demand for that in China. And frankly, this is why I think it's been important. It is important for NVIDIA to be allowed to compete in China. And Jensen's talked about this some. And the worry is that, they have this ecosystem, but if you completely block them from China, you force the local Chinese developers to potentially coalesce around local alternatives and take ecosystems that right now are not very good and build them up because they have no choice. And then longer term, you worry about creating something that would be, globally more competitive than they are today. And so I think this is good. If they actually can sell in China, it satisfies China demand. It allows them to compete, and it also potentially helps to stop the move toward more robust local ecosystems that would compete more broadly with what NVIDIA has.
I'm curious, Stacy, if you had a chance to hear any of the commentary that from one of their competitors, Lisa Su over at AMD. Yeah. She talked a lot about compute capacity, the need to kind of set things up. There was yottaflops, zettaflops, a bunch of words I never heard before today. Here, did that sound plausible to you?
I mean, she said, what did she say? Compute has to grow, is grown 100x. It's going to grow another 100x. Yeah, that sounds plausible, like for sure. Yes. So AMD's in an interesting spot too. I mean, they've been behind. I mean, everybody's behind, right? I mean, I'm not going to knock them. They've built something that in some sense is impressive. I mean, they're shipping right now single-digit billions, but it was zero a year or two ago. Like objectively, that's actually pretty impressive. And if you look going forward, especially once the OpenAI business ramps, assuming it ramps, but once that ramps, like AMD starts to get a little more material as well. For AMD, I'd love to see that demand pattern broaden. One of the issues that they have is they are much more dependent actually on OpenAI's ramp than anybody else is. Lisa's talked about having other customers. We have yet to see anything concrete, but I'd love to see that broaden out for them. Now, that being said, though, when you look at what NVIDIA put up yesterday, I suspect it's one reason like AMD stock was maybe a little weaker today.
Right.
Is, as strong as maybe their MI455 is, I mean, like Rubin looks like a beast. And so it's going to be tougher potentially to compete with that.
Right.
But at the same time, this market is so big. I mean, AMD doesn't have to go out there and do $500 billion worth of sales. If they did 25 or 30 at this point, like that might be enough. Right.
All right, Stacy, we got to leave it there. Always great to speak with you. That is Stacy Rasgon. He is Senior Analyst of U.S. Semiconductors and Semiconductor Capital Equipment over at Bernstein Research. Meanwhile, quick check on where we closed out on the day. The S&P 500, I believe, closing at a record, knocking on the door of 7,000. You can see the stocks, also the semiconductor index, rallying hard today, as did the London Metals Index. What didn't do too hot was Bitcoin, down about 0.6%. This is the close. Chevron lining up a small fleet of ships sailing to Venezuela as the company emerges as the only exporter of the country's oil following Maduro's ouster. This, as the White House plans to meet with oil industry executives. Joining us now, I'm pleased to say we have Patrick Duddy. He is a visiting senior lecturer at Duke University and the former U.S. ambassador to Venezuela for both President Bush and President Obama. Ambassador, fantastic to have you with us. I want to back up a little bit and just talk about what unfolded over the weekend. We know that over the past several months, the U.S. military has really ramped up its presence in the region. But even with that in mind, were you surprised at all to see this weekend raid and the ouster of Nicolas Maduro?
No, I was not. It was evident for some time that the force which had been deployed to the southern Caribbean was larger than what might have been necessary if the only mission had been to blow up drug boats. Additionally, after the forces in the Caribbean struck that port facility the other day, a couple of days before the apprehension of Nicolas Maduro and his wife, it was my view that that signaled to really the entire region, and it should have signaled to the Maduro regime that President Trump was not joking. This was not a bluff, and in striking the port, that is to say, President Trump, had made clear his willingness to go further.
Yes, certainly. Now, with the benefit of hindsight, we can say that this was not a bluff on the part of President Trump. And I would love to hear your thoughts on what the motivation is here. What is the U.S. trying to accomplish? Is this about pursuing a regime change in Venezuela? Is this about drug trafficking? Or is it as simple as oil? What do you make of it?
Well, I think it's a combination of almost all of those factors. What I would suggest is that it is important to understand the nature of the regime. The Trump administration has said repeatedly, this is not a legitimate government, and that is factually accurate. The Maduro regime was not recognized as legitimate by most of the democratic nations in the world. They walked away from the most recent electoral exercise, which they lost overwhelmingly, as their legitimacy evaporated, the regime became increasingly authoritarian and repressive. This resulted in, among other things, 8 million refugees, 8 million Venezuelans fled their country. That's an enormous outflow. And not surprisingly, as their illicit economy tanked, illicit activity spiked, and that means drug trafficking.
Yeah, I am curious, though, Ambassador, as to what the solution is, because when we talk about Venezuela's problems, this is not something recent. When you were advising presidents back in the day, I think Chavez was on his second go-round as leader of this country. I can't remember a time in my lifetime, at least not as an adult, where we've seen a viable, stable economic machine in Venezuela. Do you have any hope or faith that it will be different this time with whatever changes are afoot down the pipe?
Well, I would say hope, but perhaps not faith. When President Chavez was elected in 1998, Venezuela was producing around 3 million barrels of oil a day. Today, it is barely, and perhaps not even, producing 1 million barrels a day. Between 2013 and 2023, the economy contracted more than 70%. Some argue as much as 75%. This has caused effectively chaos on the ground. And I think that what we're seeing with the Trump administration's approach is a determination to revive what has always been the heart and soul of the Venezuelan economy, which is the oil sector. And that sector is dilapidated, it has been incompetently managed, and there has been an enormous outflow of petroleum professionals.
Yeah.
In fact, something like 18,000 of them were fired by President Chavez after a strike in, I believe it was 2002. And then he dismissed virtually the entire workforce in 2003. So I think that what the Trump administration has decided is that if they can build back the oil sector, it will not only be good for Venezuela, it will be good for us, it will be good for the region. This is going to require a measure of social stability in Venezuela. And that's the challenge of the moment. After all, Maduro and his wife are gone, but the regime is still in place.
Well, that's what I'm curious about. I mean, why should we have faith that stability will come if the people that Trump himself, the Trump administration itself, has said we're comfortable with are basically the people who are working under Maduro? Do we have any sense that their allegiances would somehow shift away from Maduro and to U.S. policy?
I don't think their allegiances are going to shift. And in particular, Delcy Rodriguez, sworn in, I think, yesterday as the interim president, was a part of Maduro's inner circle. What I think is going on is the Trump administration has decided to work with some of those people who are still in positions of authority to manage a transition. What I believe is the case is that the Trump administration wishes to avoid the kind of mistakes that we and others committed in Iraq after the fall of Saddam Hussein. Central to that was the U.S. went in and essentially dismissed the entire political class as well as all of the military. And what followed was chaos and something that looked awfully like civil war.
All right, Patrick, we have to leave it there. And that's a great point. We should point out just about an hour ago, we had caught up with Richard Haass, of course, who was very instrumental in the march into Iraq and Afghanistan. We'll catch up with you again soon, I'm sure. Ambassador Patrick Duddy there, former U.S. ambassador to Venezuela. When we come back, we're going to speak with the former New York Fed president, Bill Dudley. This is Bloomberg.
Well, the next pick for Fed chair is looming, with President Trump previously noting that he might announce his choice in January. Former New York Fed President Bill Dudley warning Trump's potential pick is, quote, not the only challenge the world's most powerful central bank will face in 2026. I'm pleased to say that Bill joins us now. Actually, you listed 6 things that the Fed needs to worry about here. And I want to start with the first one, and that is independence. Tell us why that tops your list.
Well, it's important because if the Fed is perceived as losing their independence in monetary policy, financial markets won't like it because they'll be worried that the Fed is going to let inflation get out of hand. If the Federal Reserve basically does what President Trump wants, which is dramatically lower interest rates, the outcome would be higher inflation expectations, a steeper yield curve, higher bond prices, higher bond yields, a real mess. And so the incoming chair has got a difficult problem. He's got to basically keep peace with the central bankers at the Fed and the Fed staff, at the same time not irritate the president too much. That's going to be a very, very difficult channel to walk down safely.
Yeah, absolutely. Situate that desire from the administration, from President Trump, for lower interest rates against what we're actually seeing in the economy, because you also write that politics aside, the Fed has ample reasons to hold steady here.
Yeah, I think what's happened over the last few months is, one, inflation hasn't gone up as high as people thought due to the pass-through of tariffs. The tariff increases were more modest, and so the peak in inflation is a little bit lower than what people thought. Number 2, shelter cost inflation is coming down, and that's likely to continue in 2026. And number three, it looks like the economy is actually picking up momentum. Obviously, we had the government shutdown that's going to distort the fourth quarter. But if you think about easy financial conditions, fiscal policy stimulus, AI investment boom continuing, that all argues the growth side is going to be a bit firmer in 2026. So less worries about inflation, less worries about downside risk to growth. So monetary policy itself will probably be, pretty much on hold for much of the year in 2026.
Yeah.
But still, plenty of issues for the Fed.
Well, when you say monetary policy might be on hold, are you including the balance sheet and the potential changes or maybe lack of changes to that balance sheet?
Well, the balance sheet right now, the Fed's on a path that basically they're going to expand reserves in line with demand to keep reserves ample, to make sure that there's enough reserves in the banking system to satisfy banks, and so there's not upward pressure on money market rates. We saw some upward pressure on money market rates over the last few months because reserves were starting to get scarce, and that's when the Fed came forward and said we're going to do reserve management purchases of treasuries to ensure that reserves remain ample. Now, the reason why that's an issue for 2026 is some of the incoming candidates for the chair have raised the issue about, well, I really want a smaller balance sheet. Well, you can't have both. You can't have ample reserves and a smaller balance sheet. And if you switch from ample reserves to a smaller balance sheet, that's going to really change how you conduct monetary policy. So that decision about the balance sheet, what that incoming chair wants and on that subject is important. And whether he can get his way is important as well.
I do have to ask you, Bill, and just pivot here a little bit to the issue of banking supervision, which you highlight in your column today as one of the 6 big things you're keeping an eye on. But I actually want to go back to a column that you wrote back, I think it was slightly before Christmas, about the regional banking crisis. There was a great report put out that I think Randy Quarles led. And it was really about the idea that maybe our supervision, at least as we know it right now, is not quite up to snuff to prevent that. And I am curious about some of the changes, at least what we know publicly, that Michelle Bowman and others have been working on, how that would actually address that in a positive way, if at all.
So I think what Michelle Bowman has proposed is good, that basically you need to focus on things that propose material risks to bank safety and soundness. Stop making regulatory policy, supervisory policy so complicated, so complex, so duplicative. So that's good. But then the question is, how do you take that from theory into practice? That's number one. So we have to actually see how does that translate actually in terms of reform, in terms of both supervision and regulation. The second thing that was the Randy Quarles exercise, and I participated in that, is how do you change supervisory culture to focus more on outcomes rather than process and get supervisors to intervene earlier when they see things that are actually going off track. I mean, the reality is Silicon Valley Bank didn't have a chief risk officer for many months, and yet there was no forcing response on behalf of the supervisors. The interest rate risk that Silicon Valley Bank was taking on was evident for many, many months, and the supervisors could have responded more aggressively. So you also have to have the right culture and supervision to encourage people to step up and intervene earlier when they see that things are going off the tracks.
Right. All right, Bill, sadly, we have to leave it there. Hope to speak to you again soon. That is Bill Dudley. He is former New York Fed president, also a columnist for Bloomberg Opinion. Really fascinating conversation on the Fed in 2026. But what an exciting day we have tomorrow. Yeah, exciting day tomorrow here as we set you up for what to watch. We're going to get some earnings in the morning from Cal-Maine Foods, a big egg producer, but that's actually more of a broader read on inflation. Of course, eggs, of course, have become an iconic, let's say, talking point during the last election cycle. Absolutely. Very closely watched there. We'll also get earnings after hours from Applied Digital, Constellation Brands, and Jefferies. We also get some employment data, too, in the form of ADP. Yeah, this is the drumbeat to that official jobs report on Friday. But in addition to that ADP numbers, we're also going to get a read on services sector once again out of the ISM, factory orders, durable goods, and JOLTS. Oh, don't forget them. Thanks for watching us here on The Close. Katie and I will be back tomorrow. Balance of Power is up next.